I haven't had the opportunity to actually look into this in great detail, Minister, and I must admit that there's no point in trying to present myself as somebody who has looked into it in great detail. I haven't. But if I may be permitted to make a few general observations in regard to what has happened, the National Pension Reserve Fund, since we came to form this 31st Dáil. And it was with alarm and regret, actually, and against what I felt was the right thing to do, that the National Pension Reserve Fund was raided very heftily in July 2011 to recapitalise the banks in what was an over-hasty and probably ill-judged view of the capitalisation requirements of the banks and the state of their assets, their financial assets at the time, and the funding of the banks' balance sheets. The amount of money that was invested into the two pillar banks was in the order of 16 billion. And, well, it was really the capitalisation of the banks plus the contribution to the Troika funding needed to start the memorandum of understandings arrangements to manage the deficit of the country. But at the time, to have hit the National Pension Reserve Fund at such a high level was, I think, reckless, because there could have been at that point creditor capitalisation. The Euro system had strong-armed the Minister for Finance, the Governor of our central bank, and the Department of Finance into essentially insisting that the socialisation of the Irish-owned banks' losses was something that could justifiably go ahead. And that was wrong. And it's left us in the very defensive and weak position, having accommodated that strategy, of being unable to insist on and make any progress in regard to creditor participation in the recapitalisation of the banks due to the losses. And the losses keep being referred to as a 64 or 65 billion losses and capitalisation. But that's that amount represents only those losses that have been acknowledged in that way. There are further losses embedded in the banks that have not yet been recognised and that are causing the paralysis in the two main banks, preventing them from releasing their customers, their borrowers, whether they be households and businesses, to a normalised level of funding, liabilities funding. We know, and even on the front page of today's Irish Times, that the banks are being totally unreasonable in regard to restructuring and resetting to repayable amounts from the income resources of their customers, the debts, the legacy debts that are on those households and businesses' balance sheets. Now, you know, the National Treasury Management Agency Amendment Bill 2014, it's a behemoth, really. I mean, I've glanced through it, and it is trying to sort of section off parts of the labyrinth of the arrangements and operational management of parts of agencies that are part of the state, whether it be what was originally the pensions reserve, heavily depleted now, with about 6.5 billion being put into the new division with new instructions and new boards. And that's fine. But it is the opportunity, once again, to make the case, supported by the evidence out there, the 385,000 people still on the live register, the 250,000 people who have emigrated, the 170,000 households in deep mortgage distress, the 50 billion of SME liabilities at a stand of which about 25 billion are under distress and probably incapable of being repaid. The 90,000 families on the housing waiting list and the 5,000 people without homes. If you add all that up in terms of human souls, it's about 1.5 million people. And the so-called partners in Europe have not actually snapped out of their dream to understand that, in fact, for those 1.5 million people, it's a nightmare. And that a relief in the order of about 50 billion is due, and long overdue, to this country. The prom bonds that represent the losses of Anglo-Irish Bank should be extinguished, torn up, and spread and mutualised over the Eurozone. And that can be done. It's a matter of will, insistence, and fighting for our people. Another 25 billion minimally is needed for the two big banks to snap out of their paralysis and deal with their loan books so that the families and businesses representing at least 750,000 people, at least, can be worked out properly and with dignity. And it won't be a free and easy ride for those families. It'll be just putting them back to a level that they can just about honour in the rest of their working lives or their business lives. And this needs to be done, and it's an opportunity now for the government to flex flex their muscles and fight for our people. You know, Deputy Murphy conceded that he was grateful that I allowed him make his contribution because he was in a rush to another meeting. And I understand that. But you know what? There was a rush, for instance, on the 9th of February 2013 to liquidate IBRC without any due consideration and deliberation as to what that moment could have provided in terms of another opportunity to eliminate those what was going to become the promissory bonds out of the promissory notes. And when I saw the advertisements of the Labour Party, one of the parties in government, coming up to the recent European Parliament elections saying 30 billion less bank debt, that was totally misleading. It's not the case. Even 20 billion, it's not the case. 20 billion, which was going to be a cash flow obligation in the next 8 or 9 years, is now a 40 billion cash flow obligation extended back out to 40 years. That's the truth of it. And it has no business being on the backs of the citizens of Ireland. Zero. Remember this. The balance sheets of all the licensed deposit-taking businesses, banks in this country and building societies, show, without any banking inquiry being needed, at 6 monthly intervals starting in 2001 to 2008, by just looking at the balance sheets and understanding balance sheets, liquidity and solvency ratios, loans to customers deposit ratios, the size of bonds, senior secured bonds and subordinated bonds funding on those balance sheets, taken together with the aggregate of all the credit loans advanced by the banks in Ireland, including the foreign-owned banks, instead of being at a level, those assets, those loan assets on the bank's balance sheets being at a level of 3 times our GDP, it was 6 times by the time 2008 had come. What were the directors of each of those institutions in those 7 years doing? What were the auditors of those banks doing? To see the financial engineering of those balance sheets going way out of control. They were manufacturing a credit bubble. And a credit bubble is the prerequisite for an assets price bubble. And an asset price bubble is a pyramid or a Ponzi scheme which is bound to collapse. Mathematically bound to collapse. And when it collapses, The residual is